Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering our normal thing every week. On Wednesday, we have our 5 stocks with X dividends next week. So I randomly selected 5 stocks for us this week. I have Johnson & Johnson, SJW Corp, Bank of America, Union Pacific, and Kellogg. So we're going to be covering these 5 stocks, and we're going to be kind of covering whether they are overvalued, undervalued, taking a look at their chart information, and then kind of deciding whether they are recession proof and if they are worth investing in either in the short term, such as in a Roth IRA, just kind of get that dividend capture, and then selling it off in there a month or two without any issues on tax protected account. So let's go ahead and get into it. So our very first stock here is Johnson & Johnson. Johnson & Johnson, as probably most of you would know, is a holding company that researches, develops, and manufactures a diversified range of products from healthcare. It has 3 different segments: consumer, pharmaceuticals, and medical devices and diagnostics. So pretty well known company, Johnson & Johnson. I'm sure you have some of their products in your house right now, maybe baby powder or some other items such as shampoo. So ex-dividend date is 27 November, which is Monday. So you do need to own this stock on Friday or prior. They would then get paid out on 12 December. Now I have their information graphed here. Some of the key points are here that their dividend price, their stock price, their price to sales, their price to book value. So price to book, price to sales is in the 5 range. Their dividend yield is down here at the bottom, so 2.37. So Johnson & Johnson stock, when charted, shows that the current stock has a higher price to yield, which would indicate that it is overvalued at this time. The stock is under in the industry price to earnings average, below 60% payout ratio, and it's had dividend growth for 54 years. So I would consider this very recession proof. Its price to book value is 5.08, which is higher than 3, where value investors would consider a value. And here you can see their price to book ratio, or their price to earnings ratio, in comparison to their industry. So right below it. So if this stock had not had a pullback, it would actually probably be right above its industry. But it did have a pullback from around 143 now down to 138. So it could be a good time to buy in. It could not be a good time to buy in. I think it looks overvalued for this chart. You can see that as of June, it's been shooting up. So you definitely do want to do some research as far as what caused them to jump up in June and continue on this path. And if it, their price to book and their price to sales is pretty high right now in comparison. Their sales and their book value is pretty high in comparison to their current price. And this basically just kind of summarizes the information that we've covered here. Their dividend yield, they pay out $3.36 per share, pretty low payout ratio, 46.2, and they're very recession proof at 54 years. And their last dividend increase was back in April 27, 2017. They had an increase of 5%, so their next dividend increase is probably due right around that same time frame. So I've included this information. This is kind of new here, their annualized dividend growth, and then I figured I'd add the last time they had a dividend spike or hike. That way, if you guys are looking to get into a stock, you guys can see maybe when's the next time they're going to be raising their dividend. So the next stock for you guys is ticker symbol SJW. So the SJW Corp engages in the production, purchase, storage, and purification, distribution, and retail sale of water. So they're mainly in California, but they do, they ship it and such. So it does serve lots of customers, over 225,000 connections that serve customers in portions of the cities. And then they name off their cities. So I think this would be a pretty, I'm actually surprised that it's had dividend growth for 49 years. We're going to be covering that here in just a second, but I was actually surprised when I read into this one, purification, distribution, storage. So maybe, what are they? When you store a lot of water in your closets and food preparations, doomsdayers, they could have, people that prep. I thought that was kind of interesting. So they are charted here. Their price to sales ratio 3.6, stock price $67. Their price to book is a little over 3.04. Their dividend looks like 17 cents, but this is actually wrong. This is their last dividend payout. But when I looked into the stock a little bit more, This is actually a special payment, so I put in special pays. Their dividend yield is 1.30. So SJW stock, when charted, it shows that the current stock has a higher price to yield, which would indicate that it is overvalued at this time. The stock is over in the industry price to earnings average, below 60% payout ratio, and has had dividend growth for 49 years. So another recession-proof company. Its price to book value is right around 3.04, so you are paying about a 304% premium for its current stock to price. But imagine if you had bought this stock back here down probably right around this 2.4 area, that would have been 3 and below. So its price to book value is 3.04, which is higher than its 3.0, where value investors would consider a value. So if you had actually bought into the stock here back in, say, April through July timeframe, you could have got some yields up in the 1.8% area, which is actually very nice in comparison to it's at 1.3 now. And you would have got that capital appreciation, that long-term dividend growth going forward, and they have annualized dividend growth of around 7.4. So in about 10 years, whatever investment you made into that company with the rule of 72. So if you divide 72 by your dividend growth, it would be 7 by 70 or 72 by 7. So it'd be like 10 years, and your initial payout ratio, your initial dividend payment would actually be doubled from your investment. And there's them hiking it up by 7.4. Let's see here. We covered all that information. So oh yeah, the special pay right here, I can actually show you that. Actually, look at that payout ratio, 35.1. So very recession resistant stock. So even in times of need, difficulties in the market, this thing has been paying out dividends for 49 years and have a very low payout ratio. Now this stock was AGW. I'm going to go ahead and show you this stock real quick. So they've been paying out dividends since 1968. And here you can see that they paid out their regular dividend and their special dividend. So they pay out their regular one on 12/01, so on December 1st, and then they pay out their special one on 12/11. Actually, their ex-dividend, let's see here, their ex-dividend's in 5 days. Oh, this is for the special. So they're actually, the main dividend had actually cleared already. It cleared back on the 3rd, but right now you would need to buy this stock on prior to the 28th, and then special payments, they're always special. You have to read into this one a bit more. Sometimes companies will do special payouts, but you have to hold the stock longer than the ex-dividend date. So sometimes they have you hold it until you actually get paid for it. If you sell the stock on the ex-dividend date or after, you may not be eligible for the special payment. Sometimes you have to hold it till the pay date. So you definitely want to look into that. But here you can see their special pay right here. They had their regular 22 cents, and they had their special one right there at 17 cents. They are pretty consistent for the last 42 years. So back over here to the article, we covered that. So number 3, we have Bank of Hawaii Corporation, ticker symbol BOH. Now they're a regional commercial bank headquarters in Honolulu, Hawaii. It is Hawaii's second oldest bank and largest locally owned, in the majority of the voting shareholders reside. Okay, so a locally owned bank in that the majority of the shareholders reside within the state. So who are you most likely to invest your money in? It's probably local businesses that you know. So KeyBank, I've talked, or there was another investor video, he invests in KeyBank because it's local to him. Some people invest in JP Morgan because they used Chase or Washington Mutual in the past and they got bought out by Chase. So depends. Their ex-dividend date is Wednesday, so you do need to buy their stock on Tuesday or prior. You would then get paid out on the 14th of December. And here, information is charted out, 52 cents per share per quarter, yield 2.49, which is over the price here. Their price to sales ratio is 5.3, and their price to book ratio is 2.7. So BOH stock, when charted, it shows that the current stock has a higher yield to price. Let me go ahead and fix that 1 second. Okay, higher yield to price, which would indicate that it is undervalued at this time. The stock is over in the industry price to earnings average, below 60% payout ratio, has had dividend growth for the last year. Its price to book value is 2.78, and which is lower than 3.0, where value investors would consider a value. So their stock is sitting at an 18.6, their industry is 17.8. The dividend yield average is around 2.58, 2.49, or 2.59, 2.49. Annualized payout, they pay out $2.08 per share. Divide that by 4 and you get that 52 cents. Payout ratio is pretty low at 47.1. They've had dividend growth for 1 year. Now their last annual dividend growth was 4.16 on 23 January 17. Then they did an additional increase of 4% on 24 January 2017. So they increased it, then they're like, hey, we can increase it some more. And they increased it by 4% more. Now, when I checked this one, they actually did a halt on their dividend for about 10 years from '08 to 2016. Which one? BOH. Hold on. So let's go down and take a look at BOH. And we can see here that they had dividend growth since 2016. If we take a look at 2016 and prior, from right here, 2008 all the way up till 2016, they didn't do a dividend increase. So I mean, overall, you're probably good they don't cut it, and their stock probably stayed pretty consistent back during this time. They've actually recovered from that 2008 dip. They've been doing very well. But if you're looking for just dividend increase year after year without having to worry about a recession, Johnson & Johnson and that water company, SJW Corps, would probably be your better investment there. And dividend growth. So number 4, we have Unp Pacific. Now this is one that investors within my Facebook chats that I'm in, they talked about this one mainly for their dividend annualized growth that just took place. They increased their dividend. So Union Pacific owns transportation companies. Its main operating company is Union Pacific Railroad Company, which links 23 states and the western 66% of the country. Union Pacific Railroad Company's business mix includes agriculture products, automotive, chemicals, energy, industrial products, and intermodal. So one thing that, with railroads, they are needed to ship products around and move stuff around, pretty regularly. I believe Warren Buffett, there was an article, can't spell his name, Warren Buffett buys railroad, here he goes. There was an article how Warren Buffett had taken money and he began to invest in railroads. So it talks a little bit about the truth behind Warren Buffett's billion-dollar railroad. And, he's always telling other investors, hey, stay in the stock market regardless of how the stock does and whether the stock market goes down or up. But even Warren Buffett's been pulling money out of the stock market and investing it in physical companies such as the railroad company, things that are needed because the future, something may happen here coming soon. So they, when charted here, they pay out 66 cents per share per quarter. Their price is pretty high. It's the second thing here at $117.30. Their price to book is 4.8. Their price to sales is 4.5, and their dividend is way down here. Their yield is 2.06. So when charted, it shows that the current stock has a higher price to yield, which would indicate that it is overvalued at this time. The stock is under in the industry price to earnings average, below 60% payout ratio, and has had dividend growth for the last 7 years. The price to book value is 4.82, which is higher than 3.0, where value investors would consider it a value. It is slightly under in the price to earnings average, 2.27 yield, $2.66 per share. Pretty low payout ratio, below 50% at least. Dividend growth for the last 7 years, and they just increased their dividend by 11.6%. That's a very nice increase on November 17. So I know I've seen a lot of other investors out there chit-chatting about the stock, how they increased their stock, and they are happy that they did. The best time to have bought the stock would have been back here in around August, September timeframe. You can see the stock yield was around 2.33 or so percent, so very nice in comparison to where it's at a 2.06. Now our last stock for today is Kellogg's, ticker symbol K. A lot of people know Kellogg's. It's a food manufacturer that focuses on cereal and snack foods. It makes a variety of cereals, cookies, crackers, and other snacks. So it includes their other brands. Some of the main key points is that they generate these, they manufacture in 17 countries, and then they market them in over 180 countries. So not only is Kellogg's a national company, it's international. It's like Coca-Cola and it's like Pepsi. They're very diversified, different segments, and they're all over the world. So regardless of how one economy does, they're generating money, outside of just the United States. Their ex-dividend date is on 30 November, which is Thursday. You will then get paid on 15 December. So here we actually have it pretty not too bad here. 54 cents per share. They recently increased it here. Back in 28 July 17, they have a price to book which is actually pretty high, 11.53. I was actually surprised. So that means that their current price to their sales is actually pretty high in comparison to what their sales ratio is. Their yield is 3.27. Their current stock price is $64.31, and their current price. Oh, this is price to sales. So price to sales is 1.7. So their actual price to sales isn't too bad. It's almost even. You're buying what you're buying is right around what their their sales, how their sales flow is. Now the book value of the company, they may have quite a bit of debt. So the stock price in comparison to their book value, it looks like their book value is, you're paying quite a big premium here. You're basically paying a 1,153% premium for the current stock price in comparison to the price. So if this price dropped down maybe down to the $55 range, then you may see that this price to book ratio would drop down quite a bit. Not too sure on what I would consider Kellogg's at a good price for its book value, but I mean it's very diversified, so it's not going anywhere. It's a huge name brand company. They've I believe we covered quite a bit of this. So dividend growth 12 years, so recession proof. Price to book value pretty high in comparison to where value investors would consider it a value. It is over in the price to earnings ratio on their stock in comparison to their industry. And they only have a very low annualized dividend growth of 3.84. So those are the 5 stocks that we covered. Again, that we had Johnson & Johnson, SJW Corp, that water manufacturing company. We have Bank of Hawaii. We had Union Pacific, that railroad, and then Kellogg. So out of all 5 of these, I wouldn't specifically invest in any of these right away. I've been looking for a position to get into Johnson & Johnson for quite a while. But when I became a dividend investor back in May, now this one did not pop up as far as, there were other better opportunities, and I was like, what, maybe it can continue falling, but it did not continue falling, and instead just kind of jumped up on me. So I'm waiting for another opportunity to buy into the stock, which I'm sure there will be going forward. There'll be some sort of a pullback on Johnson & Johnson. So SJW Corp, this one definitely needs a bit of a pullback too. I could see this falling back down into the $60 range. Just kind of where I would look at it a little bit more. Right now, I would not touch that stock. BOH. So out of all these stocks, the one that I would probably pick would be BOH, just because the current dividend in comparison, or the yield in comparison to its stock price. The stock price has been bouncing. It goes up and down quite a bit, so it's on its way down. It hit its support. It's recovering back upwards. It actually has a pretty nice price in comparison to its book value of the company. It's had nice, decent dividend increases. It's actually increased over 8% this year. The last time they've increased their dividends was about a year ago, but prior to that, they never did a cutback. They didn't increase it because they were looking to spend their money increasing probably their revenue, their net income, maybe help out their free cash flow. And if I take a look real quick at Bank of BOH, so let's go do that real quick, just BOH. We'll take a quick look at that one and take a look. I would like to look at its free cash flow, its net income for the last, we'll say 5 years, and take a look at its percentages. So they are up in the last 5 years. Their revenue's on its way up, their net income is on its way up, and their free cash flow here, they may be doing some acquisitions, or let's see here, we're taking a look at percentages. Let's just take a look at unchanged. So their free cash flow is still in the millions, their revenue is on their way up there, so pretty nice. And yeah, that's it. So my number one pick for the 5 stocks that we covered would probably be ticker symbol BOH. So what would be your, if you had to pick one of the 5, which one would you invest in for the following week, for dividend capturing? Because I could see me investing a little bit of money, picking up a couple shares, get that dividend capture, and this stock would just continue on its way up back to be balancing out right around $84, $85. And I would get in and get that nice dividend. So that is it for this video. I want to thank every single one of you guys out there watching up until this point. If you did like the video, hit the like button below. If you are brand new to my channel, hit the subscribe button for future financial videos. If you have any questions about the stocks that were covered, if you'd like to see anything added to these, go ahead and leave that in the comments below. I will take your suggestion, and of course if you do leave a comment below, I always reply back to you guys, so I always look forward to different comments. So thank you again for tuning in, and I will see you next time. Have a great day.